G'day folks, Jim here from Orchard Forex. It is Saturday the 5th of June and Friday's unemployment report from the States, while slightly below expectations as far as the non-farm payrolls figure is concerned, still showed that the US economy is continuing to grow at a steady pace while not actually becoming overheated. So it was really pretty much a Goldilocks result as far as the various asset classes were concerned. A good result without creating any new renewed inflationary pressure, I think, is the message that we should take from there. The economy actually created 559,000 jobs in May, a sharp increase from the upwardly revised 278,000 in April, but short of general expectations of 650,000 jobs being created. The headline unemployment rate fell to 5.8%, slightly better than the 5.9% that was widely expected. And the end result seems to be maybe the Fed are actually correct, and inflation may not be the major issue that's been eating away at markets and traders. And indeed, the US 10-year yield on Friday fell from 1.63% to 1.55%. This allowed stock markets to post modest weekly gains, just below their all-time highs as far as the US indices were concerned, while the US dollar gave back some of the ground that it had won following the release of last Thursday's ADP figures. The weaker dollar also allowed the precious metals and oil to make some gains, and in the course of the coming weeks, I suspect that this course of events may continue. Anyway, without further ado, we'll go and have a look at the technical possibilities for the upcoming week, starting with the dollar index as per normal. Okay, so here we have a daily chart of the dollar index, and I'm not really sure if it's trying to make a base here or not. It didn't have a very special day on Friday. It closed back down towards the 90 the figure area, having tested this sort of 90.65 area. If we do get back above there, then I think we're possibly going up towards the 91 and the possibly even 91.60, that being the 100 and 200 day moving averages. I don't think we should expect that early in the week, and it may be that we just chop around here for a couple of days. There really isn't an awful lot of data out over the course of the week to drive markets, particularly from the US. We do get the US inflation data out on Thursday, and we've got the Michigan consumer confidence numbers coming out on Friday. But until then, I think we're possibly just going to chop around here, either side of 90. It does look to me as though for the time being we've formed a bit of a base down here below so this sort of 89.65 to 89.5 level. I'd be kind of surprised if we broke down there early in the week. And like I say, I think on the top side we're really above 90.50. That's going to be some resistance, but beyond there I think we can head back to 91 and maybe 91.60. The daily indicators are slightly positive, while the weeklies do seem to be flattening out somewhat above this trend support here going back to February 18. So I don't really think we're going below this level 89. Where's that? 89.40. I don't think we're going back below there this week, unless we see a major surprise from the US inflation data. We're also coming to the US driving season, so markets are going to thin out a bit. Those who can travel, I think, will want to travel. So I think there'll be the markets, I think, are going to be a little bit sideways over the next few weeks. So all up, I think, as far as the dollar index is concerned, you probably look to buy it at 89.5, and you sell it at around that 90.60, 90.50 level, somewhere around there, and trade that range. As far as the euro is concerned, we'll go and have a look at the euro now. Okay, here we have a 4-hour chart of the euro, and as far as the euro is concerned, with in relation to the dollar index, I think we're probably fairly range bound, 122.70, maybe 123 on the top side, and I'd be kind of surprised to see us back below this 121 early in the week. If so, if I'm wrong there, then we can head back down to this 120.5, and I'd be looking to buy it down there. So basically just trade the range. I don't think we're really going to move too far. The 4-hour chart's slightly positive as far as the start of the week's concerned. The dailies, here we have a daily chart. They do look a little bit heavy as far as the momentum indicators are concerned. But once again, we've got a fair bit of support coming in down around here. The blue line's a 100-day 55-day and 200-day moving averages, either side, either sides, or 119.70 to 120.50. I'd be looking to buy it down there because I think eventually the US dollar is going to come back under pressure in the second half of the year. So I think eventually the euro probably is going to test this level up here, so 123.5. But it's going to be a long, slow process, I think, for the currency markets in the next month or so. I won't go into dollar yen. Sterling's been doing bits and pieces. Sterling has been struggling to take out this February high, sort of this 142.5 level, 142.40. And at the same time, it's finding good support just above 140. I think for the time being, just continue to trade that range. If anything, sterling might come under a little bit of pressure if the COVID numbers look as though they're getting out of control again. But for the time being, I think, as I say, just trade that range. Buy it above 140, sell it at 142.5. I wouldn't be looking for too much more. 4-hourly chart's not telling us a great deal. Possibly a minor bid for Monday morning. The daily's also a pretty non-committal, so I wouldn't be looking for too much there. It could be on the longer term. We might see a dip back down to this sort of 139, well, 140 the figure. That is the neckline of that previous head and shoulders. Once again, as I say, I think I'll be quite committed to buying it down there. If we were to see it underneath the 100-day moving average, which is at 139, I'd probably consider myself to have got that wrong and be cutting positions. But for the time being, trade the range. The Aussie's been very choppy as well. This pink line here is the kind of pivot line that I've been watching over the last few months, and there's no real reason to think that that's going to change very much. We broke below it on on Thursday after the non-farms, but after the ADP number, I should say. But we're back above it. We're back at 77.50, pretty familiar territory. I wouldn't be looking for too much. The 4-hourly charts have reversed a sharp move lower. They're now pointing a bit higher. So if anything, I think the Aussie can make a bit of a squeeze higher. And in the long term, as I said before, I think Aussie's probably heading back towards 80 cents as the global economy continues to grow, and demand for Australian commodity exports will increase. So I think the demand for the Aussie is going to be there, I feel. So I prefer to trade it from the long side at the moment, but at 77.5, I'm not really too committed either way. The same applies to Kiwi. Here we have a Kiwi chart. This is the ADP number, the non-farm payrolls number. So we're back where we started, just above 72. We've got a bit of resistance here, but I suspect over time the Kiwi will continue to move back towards these highs. I think it'll be a slow process, not looking for too much. Eventually, I think the Kiwi does go higher in line with the Aussie, but it's going to be a waiting game for the time being, I think. We'll go and have a quick look at the stocks and commodity market, and here we have a daily chart of the Standard & Poor's 500, and as you can see, it's trading really pretty much at all-time highs without really looking as though it wants to do too much. We'll go back here to a 4-hour chart. So I think there's very little leeway in trying to fight the trend. I think stocks probably will grind higher. It's not going to be a quick process, I don't think, but I think they probably will grind higher, and we're probably going to see 4,300 and possibly even higher at some stage. But once again, a slow process. On the downside, I would imagine there's going to be support, sort of this down around these lows here, so 41.80, and the rising trend line is it's about 41.35.40. Going back to the dailies, if we were to take this trend support out, then the 100-day moving average is down around here, just about 4,000. I don't think we're going to get there at any point this week, but certainly I think you've always got to be prepared for a potential accident, particularly as I've shown you before. We look at the weekly charts. They are beginning to look overbought and possibly turning lower. We've got some bearish divergence, and if we go forward to the monthlies, the momentum indicators here are now becoming very overbought indeed, so just be a little bit careful. But in the meantime, don't argue against the trend. Trade it from the long side, but keep a trailing loss, I think, as we head higher. I'd have as far as the S&P is concerned, I'd probably have a trailing stop loss about 50 points from entry. because I think if we do start to see momentum on the downside, it could move down actually quite rapidly. So it's worth keeping an eye on. Have a quick look at the Aussie market. The Aussie market had a good week, and it has closed just at all-time highs at 7,300. And I think possibly you need to stay with it, because I think we're once again, I think we're slowly going to grind higher. The only thing I would point out is that the 4-hour charts are somewhat overbought, so I think I'd leave room to buy dips, but I wouldn't be surprised if we do drift a little bit lower. The dailies, though, do look mildly positive, so I prefer to trade from the long side. And the weeklies, they're also pointing higher as well. So we wait and see. But I actually think the Aussie market will outperform the US market over the next couple of weeks. So that could be a trade to buy the ASX and sell the S&P. It's not something I personally probably do myself. I'd just rather be long the Aussie market. But I think it looks quite good. The monthlies as well, as you can see, the monthly indicators, they look positive, and unlike the US indices, they're not all that much overbought. So I think there's potential for further upside here. And like I say, I trade it from the long side, but once again, keep a trading stop loss. Moving along to gold, and that had a shakeout after the S&P, after the ADP numbers. Got down here to 1855, but rallied strongly to close at 1895, just back below that 1900 level. Now this 1920 is the big target. That was the previous all-time high back in around 2011, I think it was. And we need to be able to overcome that. I'm not sure we've got the legs to do that this week. So my own view is, for the time being, look to sell it to just ahead of 1920. But certainly, if you get back down here, this 1870 level, I'd be looking to be a buyer. The 1 hour momentum indicators pointing a little bit higher for Monday. The 4 hourlies also possibly turning higher. So I'd be looking to buy dips. I think trade it from the long side without looking for too much above sort of 1910. Certainly, I don't think we're heading above 1920. Oil. As I said last week, I like to trade oil from the top side, but it's going to find it. Well, we were trading below this resistance last week. We've broken above it, but we're now up against the 61.8%. Let's close that up a bit. Here we are. So we're up against this 61.8% level here. If we can break through that, break through 70 cents, $70 a barrel, I should say, then I think 76 3/4 is probably the next stop. I'm not quite sure at this point in time what's really going to drive us there. It's the markets. I think, the Northern Hemisphere summer is probably going to see some fairly sideways, choppy trade. But once again, as I say, I prefer to trade it from the long side. And the weekly indicators are not showing us an awful lot, but perhaps they are trying to turn a little bit higher. I wouldn't get too involved in this, but right now I would be looking to buy it on a dip towards 67, 65 even perhaps, and looking hopefully for a break above 70, but I'll probably be selling it out at 72, 73. But maintain a core long position, because I think 76 3/4, and then eventually this FIBO level up here, $85. I think that's probably more an end of year kind of trade, but I think that's the direction we're heading in. Okay, we'll leave it there for now. We're just going to have a quick look at the calendar, and as I said, there's not an awful lot on the calendar earlier in the week. We do get the Chinese trade balance. That'll be another big number, and it might have some flow through to the Aussie. But otherwise, there's not an awful lot out. The Centix might move the euro around a little bit, but really Monday's a bit of a waste of time. Tuesday starts off with the Japanese GDP. That won't have too much effect. We've got some secondary Australian data, and then we've got the EU Q1 GDP and the ZEW. So once again, the euro might move around a little bit. Some secondary US data, but not an awful lot. Then on Wednesday, we've got Chinese CPI. The RBA's Kent is speaking, and some more secondary Australian data. The Bank of Canada have an interest rate decision coming up, so that'll be worth watching. And then later in the week, the highlight's really going to be on Thursday, where we've got the ECB interest rate decision and the US CPI. Not expecting an awful lot out of the ECB as far as changes in policy are concerned, but Christine Lagarde, you never know quite what she's going to say. So once again, the euro may be the major point of interest. But we have got the CPI and the jobless claims coming out of the States on Thursday. And then on Friday, apart from the UK manufacturing data, there's not an awful lot apart from the Michigan consumer sentiment figures. So that's really about it. And it will be a long weekend in Australia next weekend, so there won't be a video. I'm going to be away for that. So anyway, we'll leave it there for now. Like I said, I think it's going to be mainly a choppy week for most asset classes. Not a huge amount of direction. I like to be long of stocks. I like to be short, slightly short of the US dollar, but keep a trailing stock because it could end up just being a choppy week, and you don't want to give too much away. So without further ado, we'll leave it there for now, and have a good week's trading. Talk to you soon. Cheers.